Is there more good news on mortgage rates coming? What does the housing market data mean for buyers these days? Today, we get to ask a seasoned economist about the housing market's biggest questions. What's going on, everybody? I'm Henry Washington, and welcome to Bigger News. Dave Meyer is out on vacation still, so I'm bringing in my great friend, Kathy Fettke from the BiggerPockets on the Market podcast to hang out with me. Kathy, what's up?
I'm so happy to be here, and I'm excited for today's show. I'm sad that Dave can't be here to help us break down this real estate news, but we have got such a great guest now, probably my favorite economist, who's going to just help us understand what's going on out there.
Yeah, we get to get a little nerdy without Dave. It seems a little wrong, but we're gonna give it our best shot. We are talking with Ralph McLaughlin. He's a senior economist at Realtor.com. Ralph is going to walk us through the latest data on the housing market, including the state of mortgage rates and what we should expect of them in the future. We'll talk inventory trends and how they relate to prices. And we'll talk about what markets we're seeing more inventory in or what markets we're seeing a little less inventory in, and what he expects for the housing market for the rest of 2024.
Well, my goodness, let's dive in.
Mr. Ralph McLaughlin, welcome to the show.
Thanks for having me on. I'm an avid listener of the podcast, so it's a real pleasure to be here.
Oh, man, thank you very much. And thank you for supporting the show. So before we jump in, can you tell us a little bit about what type of economics reporting you specialize in?
Yeah, well, I mean, any and everything with respect to housing. Realtor.com focuses on both owner-occupied housing listings and rents and rental units. So we kind of have both sides of the market there. Me as an economist, I've been an economist in housing for about 2 decades now. So there really is very little that I haven't dove into. But my expertise over the years that I've gravitated towards has been new supply. And on the side, I'm also a mom and pop investor. So it's great to be here and talk about the investment side of things for a change.
Cool. So look, there's a lot of things that we could talk about given your experience. And but let's be real. Everybody wants to know what's going on with mortgage rates right now.
Well, it's a very, very good question, especially in this sort of climate. We are seeing mortgage rates starting to come down a little bit. There are signs that they may continue to come down by the end of the year and early into next year. And that's because it appears the Fed is getting a handle on inflation. The most recent report, PCE, shows we're down again to 2.5%. The target's 2%. So we're inching our way there. So that's the great news, right? It's the great news that everyone's waiting for. Rates are going to come down. The lukewarm news is the Fed has been very clear that they're going to take the stairs down. They're not going to take the elevator. So we shouldn't expect things to drop like right away, right? If you're expecting, 5% mortgage rate land, like we're not going to be there, probably anytime soon. It's going to take a while, but the glide slope is good for a soft landing. And I think that's, it's a good spot to be in.
Well, we took a rocket ship up, so the stairs down.
Yeah.
Go ahead, Kathy.
I was just wondering, some people have said that the markets have already priced in those rate cuts in terms of with mortgage rates. Is that true? Or do you think that they'll continue to go down that staircase?
It's a very, I mean, the market certainly is priced in almost 100% a rate cut in September. And that's a big change. I mean, even earlier this spring, the market was not expecting a rate cut till even December. So we are seeing some short-term accounting of that in markets. I think what markets are going to be unsure of is how quickly the Fed is going to come down those stairs. We know they're going to take the stairs, but is it going to be September? Is it going to be December? And then, cuts at every meeting after that? Or are there going to be more spaced cuts, right? So even though it's the stairs, we know it's going to be slower. We don't know if they're going to be, sort of running down the stairs or just really going one step at a time, like an old dog.
So many people are confused about what the Fed is doing in cutting rates and how mortgage rates kind of operate separately, more tied to the bond market. So have bond investors already done their thing, knowing that these rate cuts are coming? And as a result, are we kind of where we're going to be with mortgage rates for a while? Or do you see mortgage rates coming down as the Fed cuts the short-term rates?
So certainly we've seen the 10-year Treasury start to come down and start to price that in already, at least for a September cut. I don't think the market has really priced in the cuts for next year. So certainly I think 100% capitalization of rate cuts for September. Not fully 100% for December, and I think very few for early next year. So there's still room for rates to come down as the Fed signals. But there's another source for rates to come down, and that is the actual spread. So that is the spread between the 10-year Treasury and existing mortgage rates. And that spread is at, close to, it's not all-time highs, but it's high, right? And so, we could get some squeezing of that spread, which would be welcome news certainly for home buyers and investors. So even though the market may have priced in, a lot, of the cuts that we may have this year, that spread, I think, has room to tighten a little bit.
Well, that is what our listeners want to hear is bottom line. Are we going to see lower mortgage rates or not? So I think fingers crossed a little bit, at least a little bit better rates coming soon.
Better times ahead. But it's not going to come all at once, and it's not, but investors and buyers are going to have to be patient.
So in my market, what I'm starting to see is that things are slowing down a little bit, meaning that houses are staying on the market a little longer and inventory is going up. Now, my market's a little different than most other markets, but we're still seeing a little bit of a bump in inventory, and we're seeing things sit on the market a little longer. Can you tell us, what are you seeing in terms of housing market inventory across the country?
Yeah, I mean, I couldn't have said it better myself about the national market. The national market's doing the exact same thing. In fact, maybe heightened a little bit more. We are seeing pretty impressive growth in inventory on a year-over-year basis. Inventory has grown by about 35 to 40%. That's amazing. Even just 6 months ago, we were worried that inventory is still tight, and that's going to keep a high floor for any potential movement in prices. That's changed almost 180, and I think we are going to be approaching the highest inventory level in a post-pandemic environment very soon, if we're not already past that now. Real estate indicators are often lagged, so it takes a little while to figure out where we're at. But if we're not there now, we will be there very, very soon. And what we're seeing as a result of that are two different things. One, you mentioned that homes are moving slower, and that's certainly the case. The average home now spends about 45 days on the market, and that's up about 4 days from last year, and it's up a couple days from last month. So homes are not being taken off the shelves at the rate that they were even just 6 months ago. So that's going to be welcome news for those that are looking, to acquire properties. And the second thing that we're seeing is that sellers are cutting prices at a higher rate than they were a year ago. A year ago, they were cutting prices about 14% of the time, 15% of the time. Now it's inching up close to 20% of homes are having price cuts on them. So again, this is the market, I would say, normalizing and cooling slightly. But really, if you look at where we are today relative to the pandemic, it's still a very tight market for folks. But it's loosening and it's normalizing. And I think for those on the side of acquisition, things are going to feel a little different out there when you're participating in the market than they have at any time post-pandemic. But if you've been in the game for a long time, you're still, it's going to be all right. We're tighter than we were before the pandemic, but things are looking a little easier than they were in the last 5 years.
One of the things we try to do here at BiggerPockets is explain the difference between some of the scary headlines that really are just meant to freak people out versus the reality. And yes, inventory is increasing. But the way we've been looking at it, especially on our other podcasts on the market, is that this is a good thing. Inventory was way too low, with so little supply on the market that was driving prices up. Now that inventory is rising, don't freak out. Like, that's the message we're trying to give people. Don't listen to the headlines. Don't freak out. This is a positive thing. Would you agree? Or would you say that with all this new inventory, it's something we should be concerned about?
Right now, there's no reason to think we should be concerned. It appears that the Fed is going to grease this landing and not put the economy into a recession. If the economy were to go into a recession and we were, to see lots of job losses, then sellers might be forced to sell. Right now, they can just take their home off the market if things aren't going well for them. Right. So I use the term normalize very, very explicitly because the market is normalizing. It's not collapsing. It's getting back to actually a very healthy market. We've had a very unhealthy market for the last 3 or 4 years. And it's better to have a market like this that's normalizing, that's healing, than it is one that continues to be out of whack. Because the longer a market's out of whack, the higher the chances are that we get, an overcorrection, or we get a correction that may cause severe economic pain, at least on the housing and real estate side. But there's no signs that I can see that we're in that kind of market.
I couldn't agree more. Like, I think what you're saying is it's essentially what we need, right? We need a healthy housing market. And I think people have normalized an unhealthy housing market. We've been in this pinball machine for the past 2 to 3 years, and people have gotten used to it. And so now when we say things like, hey, days on market is slowing down, it's going to take a little longer to sell a house, right? It sounds like bad news, but it's not bad news. This is what the housing market, this is what people need, especially if you're a home buyer who's looking to buy maybe not as an investment, right? You want to be able to have some predictability in what you're going and doing and shopping for. You want to be able to take some time and do the proper due diligence. You want to be able to buy something. If a flipper has done it, you want to make sure that flipper did a good job. And in this kind of environment, flippers who do a bad job are going to have a problem selling property. So I think this is what the housing market needs.
Yeah, that's, I think it's a great way to look at it. As a side note, I like to use a lot of analogies with aviation because I'm a pilot on the side. So, slow is smooth and smooth is safe. So, you can relate that to this housing market. When you're moving very, very quickly, you can make mistakes. And, and that's in anything in life, right? Whether you're flying an airplane or whether you're investing in real estate, you want to move, at the pace that allows you to make the safest decisions. And, you could argue over the last few years that people have had to move so quick that they haven't been making the perfect decisions on anything. And they've been probably normalized or becoming accustomed to suboptimal decision making in the investment process. So this slowdown, and by the way, we're still faster. We're still about a week faster than homes were moving before the pandemic, right? So that's still a faster market by historical standards. But we're really just slowing down to a less hectic market is a better way to put it. So being able to do your due diligence, over 2 or 3 weeks rather than 4 or 5 or 6 days is a healthy, good thing, especially if this is an investment property, right? Where you have no real use value of it. It's even more important. So so I say it's very accurate.
I would even argue for the first time buyer is these are the people who had to make decisions in a day over the past few years. And I know at least in San Francisco, you weren't even allowed to have contingencies for inspections or appraisals. It was just like, take it or leave it. There's 100 people in line waiting for this property. You get what you get. That is not healthy. I couldn't agree more. One of the things that kind of bugs me about housing news and is confusing to so many people when they see these headlines is, that housing inventory is increasing, and yet there's so many markets in the US. Is that true for all markets or just certain markets? Are there some markets that have more inventory than others? If we kind of drill in onto the markets, which are the ones that maybe are oversupplied at this point, maybe too much inventory, and other markets where it's still hot?
Yeah, it's a great question. From a regional perspective, it's the South and West that are really booming with supply, and it's the Midwest and Northeast, the bargain belt, if you will, that really has been slow to catch up. And there's a variety of reasons for that. One, in the South and West, they build a lot of homes. And so new home building actually is that pressure relief valve for demand, and it's pressure relief on the existing stock. So you build a lot of new homes, it's less pressure off the existing stock, which means those homes don't move as fast as say markets where you don't have a lot of new construction. And the pressure is really on that existing side. So that's what we're that's what we're seeing when it comes to new supply and new inventory. In fact, the South is just about to the level of inventory that they were before the pandemic. They're getting there. They're the closest. They're about 10 to 15% away from being back to pre-pandemic levels. But in other areas like the Midwest and the Northeast, they're still about 40 to 45% below pre-pandemic levels. So that's going to take a while for them to recover. And we see that correlation with price growth as well. Price growth is starting to wane as a result in the Southwest, and still pretty robust in the Northeast.
Yeah, we just did a show where we talked about some of the hottest markets, and all of the hottest markets in terms of things selling for the best price were all up in the North and the Northeast. And you're right. Here I'm like, if you ask I live in Arkansas. So if you ask anybody from Arkansas, they'll tell you they're from the South, but our real estate dynamics kind of don't follow the South to a T. So we're a little bit insulated from some of that, but we are starting to see that slow down as well. We've talked a lot about inventory, but we haven't talked about like how that relates to price. So if we're seeing inventory slow down, one would think that maybe pricing will come down, but we're not really seeing price come down in a lot of areas of the country. Is that true from what you're seeing in the data?
It's true. I mean, yes and no. So we are seeing price cuts come down. So we're seeing more sellers cutting prices than last year. In fact, there's about 25% more sellers that are cutting their price this year than last year. So sellers are getting more realistic about what they can expect for their home. Again, that's good news. But we are not seeing prices themselves turn negative. There's still anywhere between 3 and 5% growth depending on where you are. Like, well, how can that be the case? Well, sellers who are selling usually will only take a hit if they have to. And we're in a market where sellers still have a little bit of the upper hand. They may not have to sell. They're not going through economic distress. They're not, potentially going to be foreclosed upon. They're not, being laid off or losing their jobs. So, because the economy still remains healthy, the GDP is still, we had a stellar GDP number recently that was better than expected. At the same time, while inflation's coming down, means that buyers can, pretty much pony up what sellers are asking for, or even command a little bit of a price cut. But it's not enough to cause prices to fall for the reasons that I just mentioned.
I would love to ask a personal question, because you said earlier that you are also an investor, and that's kind of rare. We often have economists who know a lot, but don't necessarily, do the work. So I love hearing that. Given that there are certain areas where there's rising inventory, and that could lead to more choices, possibly better negotiations, possibly more of a buyer's market, so you can get better deals. I mean, are those the markets you would be looking at, the ones that other people are kind of scared of because there's more inventory? Or do you prefer the hot markets where you still got to compete?
Well, I am certainly a proponent of investing in the path of progress. So there are places that are growing from a population standpoint. Many of those places now are actually seeing normalization, in particular Texas, Florida, and Arizona. Those are places that are seeing normalizations. But the good news is that they build a lot of homes in those areas. There's a lot of land, especially Texas and Arizona. There's a lot of land for growth. But we are seeing price cuts in those areas. We are seeing the market slow down, and we're seeing inventory rise. So those were hot places for investors several years ago. I don't necessarily think that there would be a lot of deals that really pencil out as far as cash flow, if that's what you're after. But there are a lot of benefits to investing that have, very little to do with cash flow over the long run, right? So there may be opportunities to get deals in some of those markets. Prices are still rising very strongly in the Northeast, Providence, Buffalo, New York. Those could be tight. There hasn't been a lot of inventory increase in those markets. Again, I'm not a financial advisor, but there are markets that are starting to look a little more, a little more normal, a little easier to get their foot in the door. I mean, just even a few years ago, I would not want to even try to acquire a property in Phoenix or Dallas or Las Vegas. But that's starting to turn a little bit. So if you're already in those markets and you're trying to maybe look for some, economies of scale with properties that you have for management, it might be a good opportunity while the market's slowing down. Now, one thing that's also important to think about from the investment standpoint is that as rates come down, again, they're going to take the stairs down like we talked about, not the elevator. But there is a delay usually from when rates come down and when the rate decreases are capitalized back into prices. So there really wasn't much of that in, say, at the start of the pandemic, rates came down. There was maybe like a 3 to 6 month window before prices started to catch up. We may see a microcosm of that. We may see a more pronounced window as rates come down here over the next 6 months to a year, where they haven't fully capitalized into prices. But you still get the benefits of, say, having a lower rate.
I want to do, given all this information, is get just a little bit nerdier. So I want to dive a little deeper into maybe just like a layer deeper into when we've been talking about that the market is stabilizing, homes are sitting on the market a little longer, but houses are still selling. So are you seeing any types of correlations amongst what types of houses are selling? Is it smaller homes? Is it that first time 3-bed, 2-bath, first time home buyer home? Is it luxury homes? Like, can we break it down a little bit? What homes are doing great and what homes are maybe sitting a little?
Yeah, I mean, the mid and lower tier markets certainly continue to be, as we've seen prices really, really grow over the last 3 or 4 years. And as we've seen rates rise, it makes buying a house an expensive endeavor. So in any sort of market where you have a variety of priced goods, if things start to get very, very expensive, demand for the middle and lower tiers go up just by the very nature of prices going up. A starter home, for example, in most markets, probably not going to have a tough time selling it, but a luxury home that's, multi-million dollars, doesn't have a lot of buyers to begin with, especially in this environment where we have high prices and high rates. So, definitely the middle and lower tier, there's going to be more demand and activity for those types of homes than the upper tier. But across all tiers, there are still buyers. People buy homes. I know this is an investment podcast, but the majority, especially single family homes, are owner occupiers, and people buy homes to live in them for a variety of different reasons that have nothing to do with interest rates. You get married, you get divorced, you have kids, you need to care for an aging parent. You just want more space. And that's as long as the economy is doing relatively well, which it is, there's going to be that evergreen demand.
So since Henry wants to get nerdy and Dave's not here to help us with that, I'm going there too. Lately, there were some headlines about the median list price being pretty steady, but the price per square foot going up. What does this mean? Does this mean that smaller? What does it mean?
Yeah. Oh, this is awesome. Okay. We really are getting nerdier. This is fantastic, actually. So this is important for those who maybe are a little more savvy in housing and real estate, important to pay attention to. So the median list price, or the median sales price for that matter, is a nice central measure, but it's a central measure, and it can be affected by the mix of things that sell that you're trying to measure. So say, for example, we're looking at homes. You can have the median price go up, not because homes are more expensive, not because they're becoming more valuable, but because you have a lot more expensive homes that just came onto the market. And same with the downside. You can have movement in the median list price downward, not because homes are worth any less, but just because there's a bunch of smaller, cheaper homes that came onto the market. So while we like to use medians, from an analytical standpoint, it's not necessarily the best metric if we're trying to understand whether or not homes largely are becoming more valuable or less valuable than they were, say, last month or a year ago. Now, medians are nice because they do represent what's on the market at a given time. So in this instance, Kathy, if you have a scenario where, median prices are not growing, but say a quality control measure like price per square foot, or a price index like the FHFA home price index is going up, it means that there are cheaper homes that are coming onto the market. That's the only way it can happen. If homes are more valuable than last year, but the median price is flat, it's because there are cheaper homes on the market. And that's exactly what we're seeing, especially in areas in the South. We've seen year-over-year growth in the 200 to 350K range of almost 50%. It's way outpacing growth of other homes. So, so I appreciate the wonky, conversation, the nerdy conversation. It's something I've studied for, a long time. So it's nice to be able to try to make that concept a little more accessible, to consumers of real estate and housing news.
Yeah, I mean, and again, that's why we do these shows here, is to just help people interpret these crazy headlines that, just even the reporters who write the stories on them don't have, the experience that you do and maybe don't know how to interpret the news. So that's really helpful.
So given everything that we've covered, given all the data we've talked about, it sounds like sometimes it's bad news, but sounds like maybe it's actually good news. What do you see as the overall picture for investors? So if you've got an investor who's like, all right, what do I do with all this information? Is it a good time for me to go buy something? Is it a bad time to go buy something? Like, how should they be digesting all of this information and using it to make a decision?
Oh, goodness. That's a very, very good question that requires a very eloquent answer that I'm going to, give a mediocre, attempt at. But
oh, no, I believe in you. I believe in you. You're going to do it.
Yeah. So it's looking like the investment environment is going to improve. The climate is going to improve. And really, I mean, just like buying as an owner occupier, the real question is, what is the timeline? So, over a long period, you could make an investment in, a relatively poor time, but that investment could actually end up being a decent investment over the long run, right? You're going to look back, just say you bought a property here in, 2022, 2023 at the height of the market, whether it was investment or for you to live in. 30 years from now, if you're still holding on to that, you're probably, it's going to be a rounding error as far as the long-term trajectory of the housing market. So if you are a long-term, acquire and hold, things are going to get better, but I wouldn't necessarily be so concerned about timing the market perfectly. I think timing the market perfectly is going to be, or not perfectly, but at least trying to time the market. It's going to be more important for the short-term investors. So the fix and flippers, right? That's going to be, something that you're going to have to sharpen your pencil on and really make sure you've done your due diligence, not just because of, the effects of seasonality that are coming up, but also, how borrowing cost, how holding cost, especially holding costs are huge in the fix and flip. And, if you can't dispose of a property at the time that you're expecting to dispose of it, man, those carrying costs can be huge, especially if you're using a bridge loan or some high cost of debt. So for the long term, acquire and hold, okay, it's going to be a little bit better, but I wouldn't worry too much about it. The fix and flippers are going to have to really be on their game here coming up, especially with the changing rate environment. But that said, there's always going to be properties that are in need of care. They're in need of updating. So it doesn't mean that you won't be able to do a fix and flip, but you're just going to have to be more prudent in doing so.
I agree. Early, if you started investing or you got into real estate investing, maybe like right before the pandemic or right after the pandemic, people always said, hey, real estate is a long-term game. But you were able to make good money in a very short period of time in that small window. And so I think people got super spoiled because they're like, I can buy something and I can make money next year on it. Now that the market has changed and the dynamics are a little different, we're really starting to see that, hey, this is truly a long-term game. And you have to have a long-term plan if you want to truly be able to succeed in real estate investing. And if you're going to be a short-term investor, boy, you better be conservative in your underwriting. And this market is really exposing people who have not been able to be conservative in their underwriting.
Yeah, I mean, it's a great point, especially on the short-term side. I mean, you have to add value. What's not a safe game, and I think largely, the market's not terribly affected this by now. But what's not a safe game is speculation. And I know when times are really good, it can make even speculators look like geniuses. But speculation is a big gamble. And, if you don't play the spec game right, you can get burned very, very quickly. So, I'd say we're sort of at an inflection point in the market now where, the uninformed spec game is not a good one to be playing right now. But, if you go back to your fundamentals of investment, of either value add on the short run, or long term, acquire and hold, there's still plenty of room for investments to be made. And, it is a good, solid asset class, housing and real estate.
Love it. Love it. I just so appreciate what you both just said is you've got to really know what your strategy is first, because there is just no blanket statement for any kind of real estate. If you're flipping, you've got to understand the short-term market a little bit better. If you're buy and hold, you've got to understand the long-term market, the job growth and the infrastructure growth, like you said, and really understand your strategy. And knowing the data and having people like Ralph available here on BiggerPockets is really helpful with that. Thank you.
Oh, thank you. I love it. It's really great to be talking with you too.
Perfect. Well, thank you so much, Ralph, for coming on and sharing your wisdom. We're down to get nerdy with us, and we appreciated it, but I think there was a lot of great information for people. So thank you, everyone, for joining us. Thank you, Kathy, for being here, and we'll see everybody next time on another episode of Bigger News.